Honolulu, here I come. You make birthdays so much fun. If you got extra moolah, know how to hula. There's no other place you'd rather be. Because when it comes to fun, Hawaii is the place for me. Hey, Big Keith. I know you're leaving soon, but I got a little something for your birthday. You didn't have to do that. Oh, trust me, you're gonna want this. Okay, if you insist. Oh, it's a United States Treasury bond. Thank you. Yep, so I invested $500, so every 6 months you can expect an interest payment of $10 from now until 2045. Yeah, with that I can afford my next flight to Hawaii in 20 years. So, thanks. I'll be leaving now. Today we're talking about U.S. government bills, bonds, and notes, which sounds like a list of things on my adult to-do list. You know, pay bills, pay the bondsman, and burn all the notes that could implicate me in any further criminal investigation. Grown-up stuff, you know. But all seriousness, U.S. government bills, bonds, and notes are debt that you buy from the government, or rather, you are loaning money to the government, and the government pays you back for your investment with interest. Finally, the government's paying you money for a change. Unlike our government, I want to be completely transparent here. We stole our opening joke from the Alvin and the Chipmunks live-action movie.
They're savings bonds. You know, in 7 years, you're gonna get to buy yourself something really nice.
Do you maybe have any that you bought 7 years ago? Ow!
And like the writing of that movie, government bonds are all about stability. Starting now, I'm going to refer to U.S. bills, bonds, and notes as just Treasuries. That way I don't have to keep saying it over and over again. Lions and tigers and bears, oh my.
Lions?
And tigers? And bears.
Yes, the main reason you want to invest in U.S. Treasuries is they are seen as one of the most stable and secure investments in the world. You see, Treasuries are backed by the full faith and credit of the U.S. government, which has never defaulted on its debt. So essentially, there's a very small chance that the U.S. government won't pay you back. And not only that, they'll pay you back with interest. The other reason is for diversification purposes. You see, when the stock market is facing volatility, bond markets generally stay pretty consistent. So if there's a downturn in the stock market, or any of your current financial investments, you can lean on the consistency of bond markets, which is why U.S. Treasuries are seen as a good source of supplemental retirement income. Now, it's possible to invest in the treasuries of other countries, but you could potentially face higher risk due to that country having an unstable government or their currency losing value in relation to the US dollar, reducing your returns. On the flip side, you could potentially earn higher yields on purchasing bonds from other countries. For today, however, we are focusing on US Treasuries. Another reason to invest in US Treasuries, they are generally highly liquid, meaning you could potentially sell them on secondary markets. They are the most actively traded security in the world, after all. Treasury markets are highly regulated and transparent in comparison to other markets like the stock market. Okay, let's talk about how to invest in treasuries. For starters, I'm biased here when I say this, but if you're seriously considering investing, especially in a diverse portfolio that includes bonds, REITs, and/or stocks, I highly encourage you to seek the help of a certified financial planner. Perhaps one that's handsome and that refers to himself as a geek and has a deep admiration for Alvin and the Chipmunks live-action films. Now, let's continue with our squeakquel, if you will. The first decision you'll have to make is whether you'll invest in bonds as an individual or with a brokerage firm. As an individual, it's fairly simple to get started. You can visit treasurydirect.gov, create an account, select the treasury you want to purchase, as well as the maturity date of the treasury, and go from there. there may be specific criteria you need to meet, such as minimum amount invested. As for a brokerage, you'll want to open up an account, navigate and decide whether you want to buy secondary or new issues, then choose the type of bond or note from there. Speaking of, the next step is to decide whether you want to bill, bond, or note. The difference between them is the length of investment, or rather, its maturity date, a date that I feel Big Keith has yet to hit. The maturity date is the day that the principal of the bill, bond, or note is paid back. First off, let's start with Treasury bills. Treasury bills are short term, generally not exceeding a year. Unlike other treasuries, you don't get paid interest until after the maturity date. And because of that, these are often sold at a discount. For example, you have to buy a bill for $850, and it can have a maturity date of 8 months, and then when it's done, it'll pay back $900. So you only made $50 from that investment, but it's over a short period of time. Treasury notes are sort of a mid-range. Their maturity dates are typically 2 to 10 years. Now, there is another key difference between bills and notes, which is notes do offer periodic returns to an investor, generally every 6 months. Let's say you invest $5,000 on a 4-year Treasury note. At a 5% interest rate, that means every 6 months, you receive a dividend that equals 5% of the principal you invested until the maturity date of the note. So on a 4-year note, you would earn $2,000 from your $5,000 investment over the course of 4 years. Now, Treasury bonds are a long-term investment. Their maturity date sits 20, even 30 years out. However, similar to Treasury notes, they generally pay back dividends every 6 months. So let's say you invest $5,000 in a 20-year bond with a 5% interest rate. The return is going to be $10,000 over the course of 20 years, plus the return of the principal. Now, that's just basic stuff. There are other things like TIPS, or Treasury Inflation Protected Securities, where the principal adjusts for inflation, or Series 1 savings bonds that potentially come with tax exemption. Maybe those would be better videos for short or something. Okay, we've glazed treasuries long enough. What are the drawbacks or considerations when choosing to invest? The first thing to consider are interest rates. If you buy treasuries when interest rates are low, the returns are locked in. So if interest rates increase and you bought a bond 8 years ago, you could lose out on potentially higher dividends. And who would want to buy your bonds if you have a 3% rate and other newer treasuries have a 5% rate? Another thing to consider, although treasuries are more stable in their returns, they don't have the high upside potential that other investment vehicles have. So generally, investing in treasuries is more so to diversify your portfolio than to be your retirement moneymaker. Still, it's an investment vehicle bond to grow fond of. Well, that's our show. Thanks for watching. And remember, my name is Bond, Treasury Bond. We'll see you next time. For me. Art.